Hello D-traders, you are watching a recap of the stock market trading. Find out the latest news in our video review. In mid-April, the stock market is going through hard times. A period of the beyond rise was followed by a period of a steady drop. The quotes have returned to the level of mid-March. They have been diving deeper into the red zone for several days now. Last week, the main stock indexes lost from 2.4 to 7.5%. They are still trading with a bearish bias. What influences investor mood and what events may change it? Let's discuss it in detail. Do not forget to leave comments down below. Stocks were down last week largely due to the release of the FOMC meeting minutes for March. They revealed that the regulator was ready to reduce its balance sheet at a faster pace than expected. Fed officials generally agreed to shrink the balance sheet at a maximum monthly pace of $60 billion in treasuries and $35 billion in mortgage-backed securities. In addition, many FOMC members in their speeches hinted at a rate increase by 50 basis points at the next meeting and possibly at another one, even though the tone of Charles Evans and Raphael Bostic's speeches was hawkish. Their comments did not surprise market participants. At the same time, their colleague, James Bullard, made more bold comments. He said he favors raising interest rates sharply to counter inflation, so he would like to commit to get to 3 or 3.25% on the policy rate in the second half of this year. The stock market reacted to the FOMC minutes with a moderate decline, while Bullard's comments pushed them deeper into the red zone. Apart from that, the geopolitical situation also exerts pressure on stocks. Now, the odds that Russia and Ukraine make peace through negotiations are very slim, so the escalation of the conflict seems inevitable. As for the main stock indexes, the Dow Jones incurred fewer losses compared to other indexes. It shed 2.41% or 800 points. Today the index keeps decreasing. The prospect of a recession is looming on the horizon. The escalation of the conflict in Ukraine, the extension of the lockdown, and the worsening epidemiological situation in China may also harm economic recovery. Bank of America even warns about a recessionary shock. Inflation shock is getting worse, rate shock is just beginning, recession shock arrived, Bank of America chief investment strategist Michael Hartnett noted. Besides, analysts reckon that the general situation in the global economy and attempts to curb inflation may push the US into a recession. The 10-year Treasury note yield has already hit 2.774%, the highest level since January 2019. In the near future, demand for safe haven assets will only strengthen because of a risk aversion. Market participants are looking forward to the release of fresh data on the consumer price index for March. The consensus reading is rather pessimistic. Inflation is expected to jump to 8.5% versus the February figure of 7.9% year-on-year. If so, the indicator will rise to the highest level in 4 decades, significantly exceeding the target level of 2%. The stock market will surely drop to new lows if this scenario comes true. The S&P 500 lost more than 3% of 500 last week. Today, it's trading near 4,400 points, moving in the downward channel. The earnings season starts this week. The largest banks such as JP Morgan, Goldman Sachs, BlackRock, Morgan Stanley, Wells Fargo, and Citigroup are going to publish their quarterly results. Analysts expect a 22.9% drop in the net profit of banks year-on-year and an increase in the income of companies included in the S&P 500 index by an average of 6.1% in annual terms. More positive earnings reports or better than expected inflation figures will definitely help the index advance. As for the high-tech NASDAQ index, it incurred the biggest losses due to the expectations of rate hikes. It tumbled by 7.5% or 1,000 over the week. The tech sector is rather vulnerable to the prospects of a monetary policy tightening. Rate hikes make the potential future profits embedded in the value of big tech shares less attractive. In addition, if inflation figures turned out to be high, it may trigger a further decline in the index. Elon Musk, who caused an 18% increase in Twitter shares last week, did the opposite this week. After his refusal to join the board of directors, Twitter shares drifted lower by 7%. Later, his comments led to a fall in the Tesla stocks. Tesla shares lost 3% after Elon Musk confirmed that 3 of its new vehicles, the Cybertruck, Roadster and Semi, would not be arriving until 2023 at the earliest. Musk made these comments at the opening of a new plant in Texas. Sales of the electric Cybertruck were supposed to begin in 2021, but they had to be postponed due to a shortage of components. This news erased all the previous gains in the shares. The price slid down to $975 from $1,124, losing more than 13%. The drop occurred despite the news that the company's deliveries of electric vehicles manufactured in Shanghai increased by 2% in the first quarter of 2022. The biggest gainer was pharmaceutical company Veru Incorporated, which tripled the value of its shares amid successful trials of the COVID-19 drug. They surged by 175% after the company announced efficacy and safety results from a phase 3 clinical trial of an oral drug against coronavirus. Veru Incorporated reported that in hospitalized patients with moderate to severe COVID symptoms, the oral treatment showed a statistically significant and clinically meaningful 55% reduction in deaths. Therefore, traders rushed to buy Veru Incorporated stocks. On this positive note, we are going to end our video review. Of course, some stocks will rise despite the main trend on Wall Street. However, the overall prospects for the stock market today are quite gloomy. We will also see whether economic reports will change the sentiment this week. We wish everyone profitable trades and subscribe to our channel and keep your finger on the pulse, and see you soon.